Hello traders, the title of the video is how to count Elliott waves like a striker. Alright, the reason why I'm using the word striker, like a footballer striker, we have a defender, we have a midfielder, and we have also a striker. So the difference between a striker and a defender or midfielder, talking about football or soccer, is that a striker usually will tack in goals consistently, which means a striker will not miss opportunities. So when we are talking about how to count Elliott waves like a striker, it means that we want to recognize the wave and we don't want to miss a trading opportunity. Let's begin the demonstration of how to count Elliott waves like a striker. Alright, so here we are. Without too much blah 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 for my side, I'm going to go very swiftly, assuming that you are a subscriber to our channel and we know what we are talking about, okay? So I'm going to apply Fibonacci extension, reverse, or Fibonacci extension, upside down, to this trending phase from 2005 to 2007. The financial instrument that we are analyzing is Ameriprise Financial Incorporated, EPIC, AMP, Alpha Mike Papa. So there was a trending phase. If you agree to that, with the information we got, it looks like it went up and then it start coming down. So we apply the Fibonacci extension upside down, because normally the Fibonacci extension, if you apply, the extension will be in the direction of the price. Because I put it upside down, here it is, the extension are below. And we highlight the 138.2% Fibonacci extension level of that price action. We are counting Elliott wave like a striker because we understand the normal first wave and the irregular first wave. We know what to look for. We know how to recognize opportunity, and we are taking them boom, 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 scoring goals, so to speak. So this is an irregular first wave, and we understand clearly that in comparison to the normal first wave, the irregular first wave has a more chance to be extended in comparison to the normal first wave. That's the big difference between the normal first wave and the irregular first wave that has escaped our radars, so to speak, talking about our wave count. So 1, 2, 3, 4, 5. You can see it has been extended. This is the characteristic of irregular first wave starting below the prior trend at 138.2% Fibonacci extension upside down or reverse of the prior trend. 1, 2, 3, 4, 5. So if you were here, you'll be telling people that irregular first wave has a high chance to be extended because it's not a normal first wave. It has a high chance to be subdivided into 5 waves. You are a striker. You recognize opportunity and you do not miss them. Doesn't mean that the price will definitely be extended during the first irregular first wave. You are talking about what? Probability. Here comes the second wave. So you say, Joe, you are still doing the old thing, supposed to put the numbers. And I say to you, my apology to traders. All right, that's the first wave. And one group of traders will say that this is the second wave right there. Is it the second wave right there or right here? Which one will you take? All right, so let's put it here. So just understand that when we count wave, so we are talking about from our own viewpoint, we want to compare it to the viewpoint of other traders. So if you are satisfied that this is the second wave, leave it there. But go into the mind of other traders and understand that other traders may call this 1, 2, 3 as the second wave. We leave it there. Then we say the price went up 1, 2, 3, 4, 5. subdivided into 5, and then we say this is the third wave. Is it the third wave? That is a correct question. Because anytime we recognize a wave, we need to put a question mark on it. Is it the third wave? Don't bang on it. Don't empty your saving account and hope that everything works well. No. Is it the third wave? We will see soon. We can use the fourth wave to validate our third wave. How? Because normally, the normal third wave should not be so deep, isn't it? It should be a shallow fourth wave. Bringing us again to this Fibonacci extension. You will say to me, Joe, we are talking about Elliott wave, and you keep talking about Fibonacci. And I will say to you, one cannot apply the Elliott wave principle and discount the Fibonacci retracement and Fibonacci extensions. So by applying the Fibonacci retracement to our supposed to be the third wave, we notice that that fourth wave is quite deep. It comes down to the 61.8% Fibonacci retracement of our third wave. Are you willing to call this the fourth wave? That is the question. Or is this the real fourth wave? Or are we disagreeing with other traders? That is the question. And then you will say, oh, George, my friend, this is the fifth wave. It's all looking good. And then I will say to you, but that fourth wave, I will put a big question mark on it because it's quite deep. At the same time, we will go into the mind of other traders that put their second wave right there and try to figure out what other traders are looking at. So those traders who put their second wave right here will say, first wave, first irregular first wave, second wave, subdivided into 3. And they will say, the third wave, George, is ending right here. And the fifth wave, George, is here. What you are calling the fourth wave is a part, the first leg of the correction. Right? 1, 2, 3. And a bit of blah blah blah, and this is okay a correction, and the price is forming a flat correction. And I'll say to you, hold it there for a second, hold it there, and you say, you see, people are selling at 138.2% Fibonacci extension of this fifth wave. And I'll say to you, oh, which one is the right one? Which should we follow these people or the other people? Then I will say to you, the best question to ask is, what is the difference between the first wave count and the second wave count? The first wave count is calling this one a fifth wave, while the second one is calling this one a fifth wave. So what is this? The first group is expecting, a correction at the end of the fifth wave. And also, the second group is also expecting a correction in the form of 1, 2, 3, 4, 5 to form the C part of the correction. So the second group will be willing to sell here, and the first group also will be willing to sell here. So at this junction, they will not mess up our trade, whichever side we are taking. Talking about viewpoint. All right. All right, so let's go back again, and then so we'll be saying what is our fourth wave. So we'll be saying the fourth wave. Those traders will be saying that the fourth wave is right there. So first wave, second wave, 1, 2, 3, third wave, fourth wave, and the fifth wave. Now they say this is a correction, and a part of the correction is this one here. Let's go to the higher degree wave count to examine what is happening like a striker. So on the higher degree wave count, you can see clearly that our first wave stands, a first wave, second wave stand. So on the yearly chart, we'll put our second wave here, not here. Do you understand? not here, but here. So right here, which means on a monthly chart, our second wave of a higher degree is not here, but here. So I prefer this one. So 1, 2, 3, 4, 5, forming the third wave, and is a deep fourth wave, and probably is the fifth wave. Is that correct, or are we wrong? Those are the questions we should always ask whenever we label anything a fifth wave or expecting a correction. Hold on, please, traders. I need to do something very fast, and I'll be back in a minute. So I'm quite happy with this wave count. First wave, second wave, a third wave, a fourth wave, and a fifth wave. You may say this is a deep fourth wave. But I want you to pay attention to something on the yearly chart. If you go to the higher degree wave count, you will see that our fourth area wave has a tail, a long tail, right here on the yearly chart. So if we move our fourth wave right here, because in 2016, the price went down all the way to this point of $76, only to quickly, come back up a bit, you see. So it went down here, all right, but it went back up, okay, and it did close above the opening price. This is a very, very bullish candlestick bar. If we go back again, so look at this section instead of putting it all the way here, so which means a deep retracement. But if we ignore the tail, if we ignore this tail, this is what we are talking about, the tail. Trader did ask me a question there. If we ignore the tail on the yearly chart, it won't be anymore a deep retracement for that fourth wave on the monthly chart. So what has happened here, you can see 2016, the price went down to that level of $76, but by the end of 2016, the price went back up. See, it did close in the zone of $113 level, though it went down to $76. So what the price did here, which is very clean and neat here in 2016, in fact, it started that in 2015, somewhere there, we have a cycle point, the price performed minus 180 degree turn. So here it is. So though it went down, when it came, it returned to the starting point. And this long candlestick bar, they did make sure that the price returned to the starting point. You see, so therefore, if we cover that section, you may decide to do that or not to do it. You may consider that fourth wave as a deep retracement, or you may discount it, calling it a shallow retracement, which will be in the zone of 38.2% Fibonacci retracement instead of a 61.8% Fibonacci retracement of the third Elliott wave. So the decision is yours. Are you willing to discount the tail of that fourth wave, or are you willing to accept it as a deep retracement? Doesn't make any difference. At the end of the day, it's still the fourth wave, and your fifth wave is underway right here. All right? Okay, personally, I will leave it as it is. We leave it where it is, all right? But I just want to highlight that point to traders so they may be aware of it, though it looks like a deep retracement on the monthly chart. On the yearly chart, it's not deep as such, it's just a tail. And we are now in the fifth Elliott wave. Will the fifth wave be extended, or was it already extended on the monthly chart? So if you see from here, some traders may say, oh, it's already extended here, it's happening already here. And so if you apply Fibonacci extension to this section here, all right, we are now at 138.2% Fibonacci extension of that, section here, that fifth manual wave of that third wave. So because the third wave is ending here, this section here is the fifth manual wave of the third wave, because it has been subdivided into 5 manual waves. 1, 2, 3, 4, 5. It's a complex third Elliott wave followed by a fourth wave, and we are now in a fifth wave. As always, we will take into consideration the viewpoint of other traders that are calling this point the fifth wave, understanding that those traders are expecting 1, 2, 3, 4, 5 move down, while we are expecting the beginning of our correction. By comparing our wave count to other wave count like a striker, we know that we must give priority to sell signal below the level 14562, which is corresponding to 138.2% Fibonacci extension level of the fifth manual wave of the third wave. In all cases, if the price breaks above the high of the prior bullish move, which is the fifth manual wave of the third wave, the next challenge for that bullish progression is the 138.2% Fibonacci extension level of that prior trend, this one here. So prior to bullish signal above $145.62 and prior to bearish signal below it. So bullish above, bearish below, 145.62. Is he going to form 1, 2, 3, 4, 5 move down, or is he going to form a normal correction? That is the question. At the end of the day, we want to count Elliott wave like a striker without missing any opportunity, which means we are able to recognize the opportunity. And there was another opportunity also right here as a striker. We know that we usually see a surge in trading volume at the beginning of a new trend. There is one here, a surge in trading volume. A bit of a surge at the end of the second wave, like a striker. You will see that a surge in trading volume at the end of the second wave, at the beginning of the first wave, and at the end of the fifth wave, as we are approaching the fifth wave, during the fourth wave, we start seeing, okay, the RSI going down from overbought, especially during the fourth wave, like a striker. We should be able to recognize all this. And the RSI usually will go from overbought and return to the oversold. So during the trending phase, the RSI is going up, okay, and you will stay in overbought zone for some time up to the end of the third wave. And as the fourth wave is underway, very often as a striker, we will notice that the RSI, in most cases, not always, my friend, will go down from the overbought to the oversold, creating a bit of divergence, a bearish divergence in an uptrend and a bullish divergence in a downtrend. Here in this session here, during the fifth manual wave of that third wave, we see what we call a bearish divergence. Have you watched that video that I mentioned before? All right. Wave analysis tips, how to surmount Elliott wave analysis, technical challenges. It's a very essential, it's a very important video. All Elliott wave today must watch. And that's how we know all this. So like a striker who understands, okay, what is happening in the financial market, here it is. We will expect a divergence at one point when the RSI is going down from the overbought to the oversold. The divergence occurring, and this is another signal to buy here, because when the RSI diverging with the price doing other things. So price went up and then it started going, it disobeyed. The price was disobeying the RSI. Now the price complied with the RSI. Now the RSI is changing direction. It's telling the price to follow us. We talk about it, all right, at Day Pro Trader YouTube channel, how to trade the RSI oscillator with eyes wide open. You see, this is a typical bullish signal right here, where my cursor is. Okay, compliance, okay, divergence and compliance. Now the price is complying with the RSI in this section here, forming the fifth wave. And again, during the fifth wave, we'll notice another divergence. The RSI form a high, now will form a lower high at the end of the fifth wave. Even if the fifth wave is ascending, the RSI will form a lower high, creating a lower top at the point where the price is forming a higher top at the end of the fifth wave, alerting us that there is a high chance that we may see, okay, a correction. I need to remind traders that this video is for educational purposes. It's not an invitation to buy or sell, okay, this stock. It's not to give traders buy and sell signal, but to help traders that want to master the Elliott wave principle. This is the objective of this tutorial, to share with traders Elliott wave trading tips and tricks that they can use to improve ultimately their Elliott wave trading skills. So do not use this tutorial to buy or sell this stock. Alright. If you have any question or suggestion, feel free to put in the comment section, and in due course I will be recording another video to answer your specific question. We are the TSTW24 traders talking about how to count Elliott wave like a striker. If you find this video truly useful, let us know by giving us the thumbs up. If you think that is another poor performance, let us know by marking it down. If you think this is an essential tutorial, feel free to share with your friend on Google+, on Twitter, and also on Facebook. Happy trading to you all, and speak to you soon. This will conclude our discussion about how to count Elliott waves like a striker without missing any opportunity at all.